I'm Arvind Chari. I'm the Chief Investment Officer of Quantum Advisors. And today I have a privilege to introduce another Chief Investment Officer, CIO, whose career I would love to emulate. Eloy Lindeijer is a Dutch asset management expert and former central banker. He has a passion for driving real change at scale through better governance, impact investing, and catalytic partnerships. He's an advisor to AGMinfo, board member of the Global Impact Investment Network, and trustee of the Leer Group. Eloy served as the Chief Investment Manager of PGGM for 9 years between 2011 to 2020. PGGM is a Netherlands pension service provider for 4.4 million people and with 250 billion euros in assets under management. Prior to PGGM, Eloy was a central banker for over 20 years. He was a director of financial markets at the Netherlands Central Bank and served for payments and securities, export credit, monetary policy operations, and reserves management. As a central banker, Eloy represented the Netherlands in the ECB Markets Operations Committee, the ECB High-Level Monetary Policy Implementation Task Force, and the BIS Markets Committee. More recently, Eloy was the member of the Bloomberg Task Force on Climate-Related Disclosures, TCFD, the EU's High-Level Forum on Capital Markets Union, and an advisory group to the IFRS trustees on the market consultation regarding sustainable standard setting. Eloy studied business administration at the Nine Road University and international relations at the School of Advanced International Studies of the Johns Hopkins University Bologna Center. He is married and has 2 children. I've had the pleasure and privilege of knowing Eloy for more than 5 years. We both are members of a global pension fund association called the Pacific Pension Institute. And I've always loved interacting and speaking with Eloy, especially the PPI roundtables used to have a session called the CEO roundtable, where the CIOs from global pension funds talk about a varied aspects of governance, regulatory, portfolio positioning, risks, sustainability, impact investing. And I don't recollect a single occasion when Eloy has made some comments and has not left me thinking and not left me in wonderment and digging deep into that subject. So Eloy comes with that wealth of experience. And for all those who are listening, I would request you to look up one video of Eloy. Eloy recently retired from PGGM, and on his farewell day, he made a speech or he gave a talk on impact investing. It's on the YouTube PGGM YouTube channel, and I would recommend everybody to go ahead and look up that talk. With that, Eloy, thank you so much for agreeing to speak at the India Impact Challenge, and we really look forward to your thoughts.
Well, Arvind, that's so kind, and well, it's been a great pleasure to get to know you better over the years, and also to get acquainted with the work of Quantum, because I think that your company has been a leader in terms of bringing forward sustainable investing within the Indian ecosystem, very important partner for investors worldwide. So it's a great pleasure to be with you today. And well, thanks again for inviting me. I'm delighted to speak here on this important and both inspiring event. This is where new ideas take hold, and young leaders inspire others to buy into them. And India is particularly fascinating in this regard, as it stands for the very complex task and aspirational task to achieving both a net zero future, but without sacrificing economic growth and other sustainable development goals. And that is indeed, I would say, the ground zero for achieving net zero. So I really like the way you've coined that in the conference. And it will require transformational leadership in all sectors of society. It will require partnerships with foreign capital to scale up the transition in India. And it will involve new ways to somehow unleash the dynamism of markets in serving civil society. And allowing values in society to drive the direction of finance and capital markets and not the other way around. And as I was preparing my remarks for today, I was actually reminded of a visit I made with my family to the house of Mahatma Gandhi in Durban, South Africa, a couple of years ago. And his legacy, I would think, is certainly a source of inspiration as we seek to develop a long-term vision with the interests of future generations in mind, in a way that enhances trust in communities, serves them with value for well-being that goes way beyond the limited perspective of shareholder value in the short term. And I think that Mahatma Gandhi also coined a number of sins that we should not fall into traps. And one of them is commerce without morality. And I think that this area, typically fighting climate change, realizing sustainable development goals, asks for a different way of doing business, a different way of financing, a different way of investing. So that's something I always try to keep in mind when we kind of go through this transition and we face the different tensions that there are as we try to move from one place to the other. So let me try and share some thoughts on this issue from the perspective of somebody who has invested pensions in the Netherlands. And the advantage of working for a pension fund is that pension funds have long-term liabilities. In the case of the healthcare sector in the Netherlands that I worked for, those are liabilities stretching over 30 years because many of the people that work in the healthcare sector are still very young. So have a very long way to go for a retirement. So you have long-term liabilities, which requires you to invest for the long term, which is good when you think about a topic of climate change. Because those risks and opportunities related to climate change are very material for a long-term investor and will impact both financial outcomes, but also the world we live in 20 or 30 years. So it's imperative that we act now as time is running out. We can't wait. And that doesn't mean it's easy. Far from that. Actually, it's a journey that has evolved over time. And let me say a little bit about that. So PGGM started its journey as a responsible investor already in the mid-80s, committed to providing both retirement security and contributing to a sustainable world. And that was very much in the DNA of the people that work in the healthcare sector, that are always helping others. They want their money to be invested responsibly, but they also want to have the perspective of a pension to have once they're retired. And a pension which is somehow protected against inflation. So it needs positive real returns to generate that. People in the healthcare sector in the Netherlands put aside 1 day's work in the week into their pension fund. So they really do want that money to be invested in a way that ensures their retirement security. And that can lead to a tension, because ultimately the responsibility of the pension fund is to generate returns, financial returns, in line with its fiduciary duty. But there's also the call from plan trustees and civil society to accelerate positive social impact. Now, how do you get out of this dilemma? Well, first of all, what we did is we set very specific sustainability targets related towards carbon footprinting, lowering the carbon footprint of the portfolio, ultimately bringing it down by 50% by 2020, and new reductions are to follow, and achieving targets for positive social impact. And setting those targets at a high level that, they're difficult to achieve, and without being forced to invest to reach those targets, but you set them at a difficult level. And then if you don't actually meet them, you try to explain why you didn't reach those targets. And additionally, at PGM, we work together with industry initiatives such as TCFD, GRESB, SASB to enhance data availability and comparability within the sector. And we also invested patient capital to build up an ecosystem for ESG research. So for instance, we were one of the founding investors into Sustainalytics, and we were part of that company for 12 years. And we actually sold it to Morningstar last year, feeling that the ESG market had become more mature with sufficient providers of ESG research. And we wanted to put our venture investments in this field in a new area and into impact measurement. And I'll say more about that later. So you can take different roles in bringing forward your ambitions in this field. And I want to discuss 3 topics in this regard with you. One is how we try to access the area of markets where there are both superior financial returns to be made that go in hand with positive social impact, because that's where our fiduciary mandate to generate pension returns basically limits us to that segment of capital markets. I also want to say something about the role of increased transparency and climate-related financial reporting to address market failures. And last but not least, the role of partnerships to accelerate impact investing. Now, if you look at the Netherlands, pension funds are large in terms of relative to GDP, in terms of the assets under management. And by law, they have a fiduciary duty to integrate ESG factors into the investment process. But that law is mainly driven by risk management concerns, not so much driven by social impact. So it's more single materiality, making sure that all the risks are well incorporated as the money is managed. But over time, with increasing awareness of the ESG issues, both trustees and plan participants have come to expect that their money is invested in ways that contributes to a better world. Now, in doing so, as I said, we try to focus on this sweet spot that the former governor of the Bank of England, Mark Carney, has so eloquently pinpointed as the so-called point of divine coincidence. That's where superior financial returns and positive social impact coincide. In practice, that means that not all of the portfolio is invested for impact, only currently about 5 to 10%. But the good news is that these investments are fast growing as a part of the total portfolio. So for example, at PGGM, there's 20 billion invested with social impact goals of the 250 billion. The size of that portfolio quadrupled in 5 years' time. And PGM now aims to double the impact investment in the next 5 years in line with 7 SDGs. And those are interesting, I think, to name here because they're also relevant to where India stands. So one of the SDGs is no hunger, that is being targeted, health and well-being, clean water, affordable and clean energy, sustainable cities, responsible consumption, and responsible production and climate action. So all of these themes actually fit in neatly with the objective to reach a net zero economy in terms of carbon emissions and to reach other very important social goals. The good news is also, I think, that if you look at what's happening in the other parts of the capital markets, there's huge inflows in 2020 into ESG-focused funds. ESG-focused funds have done well in terms of performance, but we also see that now inflows are topping about 50 billion a month into these funds, which is very encouraging. So also retail investors and other institutional investors are finally making big strides in investing into ESG-related themes. So the debt market for ESG thematic bonds is now topping 1 trillion. And if you look at the size of signatories to UNPRI or the size of signatories involved in TCFD, these are all huge amounts of balance sheets representing a very substantial part of the total capital market that is committed to moving in this direction. So that is, I think, very positive news and bodes well for India as it seeks to attract capital to finance its transition. And that's not to say that it will be easy, because if you look at PGGM, for instance, it is also an investor in India, but its impact investments are still mainly in the OECD countries. And there's two reasons for that. I think that importantly, impact investments are ones that are done more directly through private markets. So many of the private markets or investments are still in North America and in Europe, or even close at home in the Netherlands, where people understand the difficulties of operating in an environment where you don't have experienced managers, or you're faced with unclear regulation, or you're really taking greenfield risks. So there is a need to keep those investments closer at home. So closer at home in this case of the Netherlands means in Europe and North America. And sometimes you have to be careful and not overstepping your field of competence. So for instance, I had an experience at PGM where we were building we had a greenfield project in Mexico. We were building the largest windmill park outside of, well, actually in Mexico at the time. And the project failed because although we had everything in place in terms of, local pension funds participating, the Inter-American Development Bank participating, we had all the licenses in place. But in the end, there were problems with actually being allowed to build at the site. And eventually the project toppled, and we never ended up building those windmills, and we lost about 100 million in a renewable investment there. So that's when trustees started asking me very difficult questions. Why are you involved in greenfield investments in an environment you don't know very well? So a lesson for me there was that if you are stepping into challenging environment of doing things that you don't have a lot of experience with, it's very important to find the right local partners. So you learn through experience. So local partners were a very important lesson if you want to drive impact investments. So for India, that means that where PGM, for instance, now is still mainly invested in public markets, basically harvesting the average risk premium available in the bond market and the equity market, and doing basically negative screening to screen out the companies that have bad business practices. It's not really involved as an impact investor in the Indian market yet, and that has to be done if India attracts capital to kind of finance its transition. So the big question for me is, how can you find good local partners? How can you build an ecosystem that actually attracts these foreign investors? And I think there's very interesting initiatives in this field. One I would like to refer to is the recent announcement in Africa by the leaders of the sovereign wealth and pension fund communities that they want to launch a so-called Pan-African green infrastructure bank that will be able to partner with foreign investors as a catalyst to pull in that long-term capital to finance the energy transition. India, I know, also has a large infrastructure fund, but unfortunately that fund kind of mixes all kinds of activities, from activities of building new coal-fired power plants to renewables, and it's very difficult for investors that have an impacted objective to commit to funds which are not very clearly focused to one area or the other. So that's maybe one lesson I'd like to share. Another is that that when you're still investing according to the old neoclassical approach to capital markets, where you trying to limit your you do negative screening, but you're basically buying the whole market as a universal asset owner, as we did through PGM in India, then you have huge interest in advancing market transparency to get better information out of companies, to understand where the risks are going forward. So the initiative of TCFD, I think, is hugely important, getting climate-related financial disclosure going, not only in developed countries, but everywhere in the world, to better see if you're on the wrong or the right side of climate history. So then you can start redirecting capital to those companies that have good plans in place for the future. So I think we'll see much more active management, much more concentrated portfolios in public markets once we get this transparency in climate-related financial disclosures. And I sure hope that a lot of that will become mandatory. So the UK is making mandatory reporting. Canada has tied in TCFD requirements for companies getting COVID support. The same is happening in the Netherlands. So this is a global movement where we're seeing more and more regulatory requirements regarding climate-related financial disclosures, which is going to really help impact investors tread into new areas where they much better understand how to differentiate between the companies that they're investing in. Now let me say something also about partnerships. Hugely important. If you're an international investor, you need good local partners, but you also need to team up with like-minded peers in influencing where the capital goes, in collaborating and measuring impacts. For instance, this summer or last summer, I worked with APG, Australian Super, and Columbia Investment Management in Canada to set up a new company, basically inspired on our experience with Sustainalytics. We say, well, there's still a shortage of impact measurement metrics, and we want to be able to map the companies in our portfolios to the Sustainable Development Goals. So what part of the revenues of these companies is related to products and services that we can actually map to Sustainable Development Goals? Not all investors target the same SDGs, but at least as you build one taxonomy, one way of mapping these outcomes, you'll get a common language. You'll be able to commonly engage with companies and drive impact investing forward and start creating impact metrics that can drive the investment process. So that was a very important development for us, that we were able to set up this platform together with peers on a global level. And I also hope that regulators will step in and make certain metrics much more mandatory. So there was a consultation process out of the out of IFRS Foundation last year, if they might set up a sustainable standards board, which can incorporate so-called non-financial metrics and set standards on a global level. I really hope that at the COP conference in Glasgow, those proposals will actually be put to effect, because it will be hugely beneficial for our community as we seek non-financial data to guide our capital in the direction that not only goes for good solid returns, but also goes for good social returns. So also being aware of time and having enough time for Q&A, I would like to basically give the floor to answers, to questions and answers at this point in time. Thank you.
Eloy, I have a couple of questions for you. So when, as a pension investor, as a long-term investor, and when you talk about impact investing, a couple of questions there. How does a pension fund look at impact? Do they choose projects for a particular impact, which could be environment, it could be diversity, it could be governance? How do you measure impact, and how do you choose projects in terms of where do you want your focus, impact investing focus to be?
Yeah. Okay. So that's a very good question. So before the Sustainable Development Goals were coined, we had already kind of defined the impact areas we wanted to work in, and in those times they were kind of linked to the Millennial Goals, but we had 4, not 7. So they were trying to mitigate climate change, trying to contribute to access to healthcare, trying to contribute to food security, and trying to contribute to water security. Now, health was very much linked into the interests of our plan participants working in the healthcare sector. Water is a big issue in the Netherlands related to climate change. The country can potentially flood as sea levels rise, with half the country below sea level. I think we can have like 1 meter sea rise, and after that it becomes highly contentious if the Netherlands can still exist. Right. At least half the country. Of course, food is and agriculture very much linked into the climate topic. Now, we found that in building the impact portfolio, that half of the investments were actually going into renewables, to existing technologies that can actually support the transition. And right. Of course, many of these technologies were supported, 5 years ago, still with very kind of interesting subsidies in Europe. So for instance, wind and solar. So a lot of the kind of investments were going in that direction, triggered by the kind of good regulatory environment, the stability of cash flows, which actually came out of those schemes. So in the UK it was very successful. They launched their green investment bank. They privatized it far too early in my view, but they actually enticed PGGM to become a huge investor in offshore wind in the UK. And that's why I very much believe in these green investment institutions that are linked to the government, that can partner with long-term investors, but they have to be independent from the government. So independent from political influence. They need technically competent staff, people that really have kind of deep technical knowledge in the industry, and they need good commercial people to be able to link up with with foreign capital. And I think the UK experience is something for everybody to learn. I think the Netherlands has even failed in this regard in attracting foreign capital because it didn't really establish an institution like that here. So over time, you can expand your goals as you learn. So in this case, PGGM added, for instance, sustainable cities, added the responsible consumption and production, the no hunger goal, because its surveys with plan participants showed that plan participants found this hugely important, and it ties in very well with the themes we're already investing in. We found that investing in food security and water security is actually a lot more difficult than investing in climate change and health. It's just the availability of projects is lower. Yeah. And we saw an increasingly amount of money going to private markets. So the challenge here, I think, particularly for India to attract this foreign capital is my worry is not enough of this capital is going to India and to emerging markets in general, because let's say that the pension funds are still too risk averse, and that has to change. So some ways of making, getting catalytic capital in there to overcome the risk averseness of these funds and let them build experience and work from there is pretty important, I would think.
Sure, great. There are three questions. I'll take the one from Tracy first. It's a message from you for the students. If they have to interested in going into this ESG impact investing space, what kind of skills should they be working on?
That's a very good question. Yeah, so it's more than the traditional, let's say, MBA spreadsheet skills, yes. Right? Yes. This world is fundamentally changing. So I think you have to do a lot of studying on the big themes of this day. Really understand what the leading thinking is on energy transition, on the other obstacles to meeting the Sustainable Development Goals, to understanding which companies are purpose-led and which not. So values-driven investing, combining that with a good knowledge of how you actually analyze company balance sheets, I think that is the sweet spot. But you still need to be willing to really dive into a lot of details and get programming skills, because there's so many data out there nowadays, much more data that you have to process than in the past. So we had people at PGGM doing a lot of Python programming, and not only young new recruits, but people all over the company, trying to build new skills, to be able to be, to be able to operate in this environment where you have to process huge amount of data and make sense of it. And often that requires making use of new tools, such as artificial intelligence, and distilling new insights from that. And I think also an international outlook. Don't be inward looking, be outward looking. We're all in the same boat. So build relationships with peers in different parts of the world, learn from them. So be interested in partnerships and other cultures as we try to meet these global challenges.
Eloy, we have 3 more questions on the queue. Although we are run out of time, would you want to take it? And should we?
Yes, we can go ahead. We can do another.
So there's a question by Rich Ryden on transparency, on ESG transparency.
Yes.
So, he's citing countries like China and Russia, where they're politically closed, not democratic. You might not get the data that you want. And they are a very large part of the population. So how does it matter in terms of you see that?
Yes, I think it matters a lot, right? So, so just alluding in my introduction to commerce with morality as a guiding post for us all. So there's certain areas that kind of lead to the impossibility to maybe invest in certain companies. So I found it quite encouraging that a large global manager as BlackRock has said, well, in their actively managed funds, if companies are not transparent on climate-related financial risks, we'll ultimately divest from them. We'll give them time to become transparent, but if they show no progress, we'll divest, right? I think that's showing, at some point of view on the good or on the right side of climate history. You need to make choices. And when it comes to the geopolitical tensions between Russia and China and other countries, I think we have to be clear where we should absolutely cooperate in areas such as global healthcare concerns, climate change. We have no choice. I mean, we're all in the same boat. At the same time, we don't need to necessarily invest in sectors that we worry about the practices that take place. So generally, China has been a great destination for investments of PGGM, so I think PGGM has more investments in China than in the Netherlands. That's not the case for investments in India. And I think there will be a rebalancing over time. India will be a larger destination for that long-term capital as it becomes clear what the opportunity set in India is, and as more understanding gets to the investors' desks in terms of the total amount of parameters they're looking at. Because as transparency increases and we have dialogues with each other on what we do and we don't want to be part
of. There's a question from Sam on the disclosure standards. Yeah, on the disclosure standards that are being used. Do you think it's going to be same for OECD countries and for emerging markets? All the regulatory ESG disclosure standards. Do you think it should be the same?
Well, I hope so. I hope that the core metrics, particularly on climate-related financial disclosures, will be similar. So with India being an important player in the G20, they've supported the work of the TCFD. India is also an important player within IFRS, with the board of trustees of IFRS and the consultation process regarding a sustainable standards board. So I would very much hope that we get one global standard. And one of the risks of the European Union now is that the European Union has forged ahead with its own standards, which can complicate matters if it moves out of sync with things that would be developed at that level. So I think it's also good for the European Union because it can influence a global standard because it's a little bit ahead of the game, but it might also want to take on board insights from that international dialogue and get something that works for everybody. Thank you so much for having me. It was a pleasure.